Meaning and features of debt funds. Debt mutual funds invest in fixed income securities such as treasury bills, corporate bonds, commercial papers, government securities, and various other money market instruments. The return on these securities is usually not impacted by market movements, so they provide stable returns than equities and are considered less risky. They provide steady returns and capital appreciation with lower risk. Debt fund has a pre-decided maturity date and a fixed interest rate which the investor can earn on maturity. Debt mutual funds hardly provide any capital protection. This is because the underlying securities are vulnerable to market movements and so they are exposed to capital erosion. There is a risk of RBI changing the interest rate due to which the underlying security gets impacted. To mitigate this risk, short-term investments can be preferred. This risk can be mitigated by investing in debt funds that have a high credit rating. Debt funds charge various kinds of fees such as sales and agent commissions, advisory and management, marketing and selling, audit and legal, and many more, which are charged to the investors through total expense ratio, TER. To avoid paying high fees, direct mutual funds should be chosen for investment as these funds have a lower expense ratio than regular mutual funds. Returns that are generated by the debt funds rely on the interest income earned and capital gains garnered from the underlying securities. The credit rating agencies such as CRISIL, ICRA, CARE, that give ratings to the debt funds also build a base in deciding the interest income. Therefore, interest rate and credit ratings are important aspects to look at before choosing a debt mutual fund. The returns that are garnered by investing for 3 years or less than 3 years are short-term capital gains. The returns which are booked on redeeming your investments after 3 years are considered as long-term capital gains and are taxed at 20% with indexation benefits. Under the categories of debt mutual funds, only the fixed maturity plan, FMP, does not allow premature withdrawal, but apart from that, all the other categories allow withdrawal by paying a minimum exit load if the funds are withdrawn before a predetermined period. These options are a great idea when one needs higher liquidity and also for short-term investments. Debt funds are market-linked investments and there are no guarantees in terms of returns. Other factors to look at while investing in debt funds are past performance, expense ratio, AUM, and others factors.